Thanks for tuning in to the Mutual Fund Show on Bloomberg Quint Live. My name is Nimesh Shah, and we are in conversation with a very special guest today. Lots of burning questions in the minds of mutual fund investors. There were falling interest in SIPs at least the last couple of months. The numbers or the conversation seems to suggest that is there a falling interest in SIP, and that's something that would be playing on the minds of investors. Add to that the geopolitical tensions of late would mean that people who in normal course will not be worried about investing might also get a bit anxious about whether or not this is the right time to invest. So lots to talk about. Guest today, a very special guest, needs no introduction really, Nimesh Shah of ICICI, who joins us right now on the show to talk about his thoughts. Nimesh, so good having you. Thanks so much for joining in. I think first the big question on the minds of a lot of investors of late the last couple of days would be that would these heightened tensions, in any form of geopolitical tensions, I'm not just referring to what's happening right now the last couple of days, would they have a big bearing on mutual fund investments? What would your advice be?
The way I look at it, as somebody has said, that in the long term, equity investments is like voting, it's like a weighing machine. In the short term, it is like a voting machine, right? Okay. So in the long term, ultimately, what gets it gets affected by is it gets affected by the EPS that the companies are going to generate. Are the Indian corporates going to earn more money in 2019-20 than what they earned in 2018-19? And what is the 3-year view on profitability growth? So that is the view that people should take rather than worry about what has happened on the border or this one. Will it affect the flows to a certain extent? Yes, it can affect flows to a certain extent. I'm not aware, right? Neither has anybody in India got the experience on that. So I would not worry about when we are looking at our mutual fund investment, we are looking at, we know there is a political risk also in May, right? It's nothing new. This has happened. Of course, there is some more risk which has come, which we don't fully know how it will play out. But we really understand that we are investing in companies where we see value today, where we see with a 3-year perspective there is value. That's the sectors that we go into, that are the corporates that we go into. So whether it is the government sector or whichever sectors that we are going into, where we are comfortable on the valuations we are entering. So whether there are issues or no issues, will this company make more money 3 years down the line than today? That's the basic question to be asked. And that's how for us, the business is routine.
Be objective and don't be emotive.
Correct.
Okay, just one follow-up question to that. Should an average mutual fund investor be worried with this whole news flow? I'm not saying the news flow is wrong, just that whether it should worry somebody when there are comparisons, and maybe rightfully so, being made about how the flows used to be in equity mutual funds and mutual funds at large for the whole of 2017, maybe for the better part of 2018 as well, compared to what's happening right now. SIPs were the stronghold. They are also showing signs. I'm not saying they've come off as yet, but maybe they could too in the next few months. Should an investor be worried?
I will give you how the flows, if you see the flows over the last 10 years, till May 2014, whatever you do in life, the flows were negative. From August 2009 to May 2014, till April 2014, the mutual fund flows were negative. In those times, the markets went up, markets went down, everything happened. You remember that phase was whenever foreigners used to get in money, markets will go up. When foreigners would take out money, markets would go down. It was as simple as that. So what did mutual funds flow do in the last 4-5 years? We became indifferent to in 2017 or 2018. The 2018 foreigners have taken out more than $4 billion during the year. But there was no impact. There have been months where foreigners have taken out more than $2 billion. And there was absolutely no impact on the market because there were a counter lobby which was buying it out. So what mutual funds did, it gave a lot of stability. If mutual funds flow slow down, and I can understand this slowing down because necessarily the mutual fund investor, unfortunately, people look at past returns and come into mutual funds. To 2018, 1 year back, I had come to your show where I had said clearly red to mid caps, right? But the maximum number of inflows that used to happen at that time was in mid caps, right? So that's the challenge. So will when there is a 2-year negative return on mid cap SIPs, will some SIPs slow? Yes, some SIPs will stop. So people who are not comfortable with that, they should stop. So I have not seen those signals coming. If you see the last 3-4 months, the number is steady. It is around 8,100, 8,200 crores. The growth has stopped, but it has not started coming down. But even if it comes down, I would not be extra worried because flows will slow down when the 1-year return is negative, right? When 1-year return is negative, flows start slowing down. That is normal. So today the 1-year return is not that great, right? So at that time, people start, it is good people think or rethink. It is good that I don't want, in a euphoria, always people make bad financial decision. In this kind of environment, if people are rethinking, it's good. that they are taking up assessment that mutual funds are subject to market risk.
Okay, just one follow-up on that. I hear that some of the larger funds, and you are amongst the larger funds, the flows haven't been an issue, but for the smaller funds and therefore for the industry at large, flows have dipped a bit. We are still yet to wait for the AMFI official data, so I won't ask you to give me the exact number or something, but a flavor of whether you believe equity flows have slowed down in February.
My sense is February figures will be very similar to January figures. When you see the numbers, you'll realize. Before coming to your studio, actually, I saw those numbers. They will be more or less, the net sales of mutual funds will be more or less similar to January.
Okay, I won't ask you to reveal anything more because...
No, but there is nothing. This is data that is available. I'm not saying I'm not. I've just read the data, what will come through, because I know we get weekly data. So 4 weeks data. This is very much in line with what happened in January.
So the small concern, and I would want to talk about the bigger concern in the minds of people, which is credit funds and debt funds, but just one small concern, and we were talking about that recently as well, that how, for example, December data showed that, one, the number of SIP registrations came off, and there could be multiple reasons, including KYC for that, but two, not just that the fresh registrations came off, but the SIP closures also picked up a little bit. There were a couple of websites which put out that data too. What could be the reasons for the same, Mr.
So, as I said earlier, people who are not happy with their SIP, they are seeing 1 year and 2 year mid-cap, 2 year mid-cap SIPs, 2 year returns are negative.
Right.
So, if people are rethinking, it's a good sense for them to take whether they want to continue in their mid-cap SIPs or not.
Would you urge them to rethink on the other side, which is that in periods of pain
Why I will not? Because they are getting more units with the same money now.
So
because it would be last thing to do that I came in an expensive market. When the market is becoming cheaper, I am getting more units for the same money, I will stop it. So it is counterintuitive to do it. But people should do their risk assessment themselves. I can't do it for everybody because I won't know anybody's allocation. If you have got 15% of your money towards mid-cap, you will continue. But if you are a primary investor, you have just started investing and the amount is entirely invested in, so there is no one advice that I can give people. Yes. It depends on how much allocation they have done towards mid-cap, how much allocation they have done towards large cap, how much is the overall allocation to equity. If somebody is coming fresh and is straight away invested in a mid-cap SIP and not have anything else, then I may ask him to, even I would, if he shows me the portfolio, I might say that you have got only mid-cap, why don't you go for a large cap SIP? But definitely I will not ask him to remove the money, but I may ask him to switch over to a large cap SIP. Okay. That can happen.
Okay. You spoke about the recency bias as well for equity funds. Would that recency bias come in and hurt the debt funds? Because the last 6 or 7 or 8 odd months, or 6 months, let's put it that way, due to a variety of factors, there have been another scanner. And at times you would have to agree that maybe for the right reasons that questions were asked, which needed to be answered.
I thought you'll give me a complimentary message. The mutual fund industry has managed brilliantly. There was a AAA company which from A it straight went to D, right, in this country, and mutual funds only had 3,000-4,000 crores of exposure in that. So till date, no TV channel has complimented the mutual fund industry on that. See, it's commendable. 1 lakh crore balance sheet goes in question mark, and mutual fund, out of the top 5 mutual funds in the country, 4 don't have that. Right, only one mutual fund after the top 5, only one had, the rest didn't have. And the overall the exposure of mutual fund industry was only 3,000 to 4,000 crores. I thought you guys should compliment us for that.
The reason I'm maybe not complimenting you is because I would presume that this is something that you would do on your normal course. You'll be able to manage money very, very efficiently, and which is the whole idea.
It is, of course, it is efficient. Last 20 years, there is one thing about ICICI Prudential. Last 20 years, we have not had a single case of delay. Right, that is one issue. But see, please understand that when we buy equity funds, I'm not talking about when we buy equity stocks in an equity fund, not all 40 stocks go up. Some go up, some go down. Right? Similarly, in a debt fund, when we are buying debt funds, there can be times that the valuation, we buy a AA company, it can become AAA also, and there can be times that we buy a AA company debenture and it can become single A also. It is not that there is CRISIL comes out with data, the upgrades to downgrade ratio. So one should look at it that if as AMC, ICICI Prudential has bought the bonds, what percentage of bonds have got upgraded and what percentage of bonds have downgraded. Upgrading and downgrading is a normal course of life. The minute you say a company is AA and not AAA, right, that means there is some probability of default in that company. A single A has got more probability of default than AA. A AA has got more probability of default than a AAA. So otherwise, why it would be AA? right? Otherwise, we should invest all money with Government of India only. If you don't want any risk, but you cannot have that you want invest in a credit risk fund. There is a fund called credit risk fund. If you invest in a credit risk fund, there can be issues which have to be resolved. I'll give you an example. We had a company, I can't talk individual companies, but we had a company in the steel sector. Right, the steel sector company, the sector, if you know steel sector, in 10 years, 3-4 years, the sector will have a problem. Right, so if I give money for 5 years, right, after 3 years, there was a problem in that company. So what do I do when there is a problem? Do I go and tell him that give me the money tomorrow? If we do that, we'll never get the money. Right, it is better to work with the company at that point of time and find a mutually agreeable solution whereby you can get back. So it is in the investor's interest that you work out a solution at that point of time. If you insist that I'll get all my money, that's what the bankers also do, right? So you have to work with those companies and over a period of time ensure that the money comes back. And the mutual fund industry also, in JSPL, we decreased the valuation. When he was rated down to D, my 100 rupees was valued in my books at 67. Slowly the valuation is coming back. The 67 maybe today 94, 95, something like that. Right? And the repayments are happening. There has not been a single day's delay. Every day there was a media headline. And till date, there has not been a single day's delay in that company. But still, there were some 40 media headlines that we had to answer. So, of course, we are managing public money. So, we are answerable. But it is not abnormal that when you give money to a A+ or a AA- company, that you can have issues and you have to resolve the issues when they come up.
You think this messaging is clear? I can understand corporates knowing, or corporate treasury books which invest into some of the schemes that the mutual funds manage, knowing the risk fairly well. But as it has happened, for example, in balance funds when dividends were promised. I'm not saying it was the mutual funds which did it, but parties associated or financial advisors or otherwise. So that was a bit of mis-selling, which you yourself adhered to in one of the shows earlier that I remember. Or for that matter, in credit risk funds or otherwise as well, because investors who invest in these funds believe that this is the slightly better return giving instrument compared to my fixed deposit. So therefore, let me go and put it here that it is 100% safe. You think that messaging is clear?
ICICI Prudential Credit Risk Fund, it says very clearly what does it do. What does a credit risk fund do? It takes credit risk and gives money outside. Right? So if you take credit risk, there can be times where, not that I'm saying there is anything in the portfolio where I believe that the risk is too high. We have managed the risk till date. Right? There has not been a single day's delay in any of our exposures, as I said earlier. But when you say, and we do not want all those risks to come up, that you are talking about mis-selling risk by a distributor. That's what you're referring to?
So that is one part that happened in balance funds. All I'm saying is the awareness about these risks existing.
So we are talking the best way to do is to talk to media and explain people. We are doing it. We are working with a lot of intermediaries also to go and explain debt fund. More than 50 shows we would have done across the country, not in Bombay, across the country, explaining people what are debt funds. Because I believe for the future mutual fund growth, mutual fund is not only about equity investing. Worldwide, mutual fund is about investing, debt investing. Debt investing is much, much, much bigger than equity investing. Because today in India, huge amount of money is sitting in debt kind of products, not in equity kind of. Equity industry is not even 10% of the debt industry.
Sure.
So we want to encourage people to invest more in debt funds, and that is why a lot of communication is necessary. We are much better off in our equity communication than what we were 10 years back, 5 years back, right? We have to actively work with media. Now we should actively work with media to ensure that a lot more awareness is created about debt mutual funds. We are essentially much more competitive than the traditional instruments because we work on a very small margin. The whole margin that is charged to the investor is 1.6 or 1.7 in a credit risk fund. So that retail potential of debt funds is 10 times bigger than the retail potential of equity funds.
Okay. So let me ask you a question. You are, there are two aspects to this. From here on, and we don't know if accidents will happen or no. I mean, Z or ILNFS or ADAG, whatever you term them as accidents or events that have happened which could have shaken the investor's confidence. My question to you is this. Would you believe that there could be certain schemes or certain houses which could have a risk of these because they are not well diversified? That is part one of my question. And part two of my question, when you're telling me that, why is it that I'm not complimenting you? I'm trying to seek an answer from you as to if you believe that the industry at large, you in your capacity as the AMFI head right now as well, would you believe that the industry at large is insulated from any kind of liquidity risks in the portfolios that it has? Because a lot of people question the veracity of the valuation of the paper that some of the credit funds hold, because that paper is not traded very, very actively. If it were to come out in the market, then the valuation would see a sharp markdown.
There are many questions ingrained in your this one, so I would prefer that you ask me specific also as I go along.
Sure.
Right. So please intervene also if you want this one.
Perfect.
So there are lots of questions in this. This includes valuation. It includes whether the risk was taken as the right way of whether the diversification was there or not. So in my mind, the way I look at credit risk funds, when you invest in a less than AAA, or even in a AAA, there is some probability of risk of delays or defaults always there. Even when you invest in a AAA, we have seen there can be a risk. As the risk will increase as you go lower the yield curve. AA, the risk is more than AAA. Single A, the risk is more than AA. So So the only way to ensure, right, that the risk is managed in a credit fund, you do all the credit checks, everything will do. Assuming that the fund house is doing all that, one essential thing for an investor is that the fund is diversified. The concentration risk should not be there in a debt fund, right? That is extremely important, especially when you go lower in the risk curve. In our company, my risk department says that if it is AAA, your concentration can be so much. If AA, concentration can be so much. Anything less than AA, the concentration cannot be more than such a percent, which is 3%. So suppose we assume that I have taken a case where I have given 3%. The current yield going on in that fund, credit risk fund, say is 9.8 or 10%. For round, we take a round figure of 10%. And suppose that 3% gets into problem. In some of the worst cases that the industry had, I think JP Morgan mutual fund had MTech Auto. Out of 100 rupees, 84 rupees were eventually paid, right? Out of 185, so 15% was went. Suppose 25% goes bad. So in 3% of my portfolio, 75 bips goes away. So instead of getting a return of 10%, you'll get a return of 9.25, right? But 9.25 is still there, right? So that's the difference that I'm trying to explain. What happened in JP Morgan was that particular exposure was some 14-15% of the fund. That created a problem. If you do not have concentration risk, right? It's not an issue. If you do not have, if out of 100 rupees, 3 rupees you have given, having challenges on the credit side will be a normal course of life.
Sure.
Right? The only way we can avoid that challenge is by diversifying and ensuring no concentration risk. So that's what I wanted to explain with an example. This is we can discuss for 3 hours, but ultimately we can have the best credit practices, and we should have. There is a separate credit department in the company. We don't depend only on the rating agencies. Rating agencies give a rating, but that is only indicative for us. I have got my central credit department, the fund managers who clear the proposals. Then there is a separate risk department which clears the proposal. So we keep all the checks and balances, right? After that, concentration risk is something that will help us. Even in the steel company that I was talking about, we didn't face any kind of redemptions at that point of time. Right, our fund sizes were not degrowing at that point of time. We were getting inflows at that point of time because we were able to explain people that out of the concentration is not there. It's only 3% of the portfolio. So that is what works.
Okay. What about the questions around the liquidity of the paper being held by funds as well? Because should there be a run, then what would happen?
See, liquidity, I think it is also not only asset side. You should understand the liability side also. When we look at a fund, right, and when we look at the liquidity in the fund, I at any point of time know what my vulnerable assets are. We assume that all institution assets are vulnerable, right? We assume that, so there is a lot of diagnostics which happens on the liability side, that what is the concentration of distributor. We don't allow concentration of distributor also to happen. We don't allow concentration of investor to happen. Like in my fund, when I started the credit risk fund, you could not invest more than 5 crores in that. Today, you can only invest maximum 100 crores in that. That is 1% of the fund. So I don't allow concentration of AUM to happen by investors. I don't allow concentration of distributors to error. It is a very widespread liability side. When the liability side is widespread, I am not prone that much to vulnerable my money moving out quickly, right? Because it is very well diversified. So it starts from there. Then there is another comfort whether it has completed 3 years or not. Because 3 years, for getting tax advantage, you need 3 years. So vulnerable assets actually start after 3 years, right? Then there is a exit load thing. So exit load, taxation, diversification of distributor, diversification by investors, those are all the parameters by which I come to know that tomorrow morning how much money can go out from my fund. To that extent, I will have liquid assets in my in the portfolio, right? Then SEBI allows, even beyond that, SEBI allows 20% of the portfolio I can do borrowings also, right? So there are various avenues available that I'll keep sufficient liquidity. So I don't think liquidity, at least I can say from ICICI Prudential side, we have got more liquidity than is required at any point of time.
So which brings me to the next question which I asked you, that would you reckon as one of the largest AMCs and as the head of the body as well now, that investor money into the debt market schemes is insulated from any kind of shocks that could come in? It could happen to individual schemes, 1 or 2 or 3, I understand, because you wouldn't know everything. But by and large, do you believe that as an industry, the mutual fund industry would not encounter any kind of shocks because of...
I have seen the bigger funds and I think more or less because they are the funds that we are competing with, they have got their institutional setups which are managing the credit risk well. As far as I am concerned, I am quite comfortable. My tomorrow is my salary and my salary will go in my credit risk fund.
Okay. Okay, fair call. I remember the last time...
Because why? I'm
Sure.
telling you, because the yields currently are very high. For the same credit risk that you take, earlier the yields were lower. Today I'm getting a better yields for the same product. So it's a beautiful time to invest in a credit risk fund. That's what I feel. We are contra investors. I told you last year, don't invest in mid cap, invest in large cap. So today I am saying that the best in a 3-year paradigm, when you are looking at a 3 paradigm, when the yields have gone beyond 10%, it's a beautiful time to invest in credit risk fund, risk return point of view.
Yeah, well, we did a show on this subject last week, so kind of somebody else who had come on the show also concurred with this topic as well. My question to you, Mr. Shah, would be from here on, for a mutual fund investor, equities, debt, or a combined portfolio, because it's best to have a combined and diversified portfolio, what is the biggest risk?
Biggest risk, I always go on one thing, fundamental thing, that is whether the profitability is coming back or not. In the short term, obviously all of us know there is one thing that is coming up in May, the political risk. And frankly, we are preparing our portfolio for any kind of situation.
Okay.
Right? That I don't know what is going to happen in May. So whatever happens in May, I am not going to subject my investors to abnormal risk in May. So I'll be more and more neutral as we approach May.
That's
because
the
you are not paying me for, even on the debt side. In the debt side, in fact, it is more important that your portfolio should become as boring as possible as we approach May. Because in an uncertain environment, I don't know whether there is going to be certainty or there is going to be uncertainty after May. When I plan a portfolio, I plan for uncertain situation, that in an uncertain situation also I should be okay.
Okay. Would you believe that uncertainty that could arise out of not necessarily the paper that has been in the schemes of funds, but because the promoter entities, the case that happened between the ADAG group and Edelweiss, for example, or L&D Finance, or the case with Z and some of the others, unfortunate as the scenarios may be, and maybe they get resolved. I hope they get resolved from an investor's perspective. But do you reckon that those issues will not be big issues by and large?
See, it depends on what you have. I will talk about as an AMC. As an AMC, say in one particular company, do I have sufficient security of a good quality base company? We have been doing advance against shares, right? Bonds which are secured by shares of promoter companies, we have been doing it. And it's one of the best businesses that we have had with not a single day's delay till now. In this particular case, in one of the cases we have had this one, but the quality of security that I have, ICICI Prudential has, is one of the best companies in India in the media, right? If the base company is good and I have got security cover only on that, I am sufficiently covered on that, right? My break-even price is quite low. So I feel that I've got more than 1.5, 1.6 cover on the good quality company, zero debt company. I've got a good quality. So it depends on what kind of security cover that you have. Okay. So we have always insisted. I have got my filters for doing advance against shares. And one of the main filters that we always use, that we should be very comfortable with the base company at the current price. So when we took it, we were comfortable with that company at that point of time at that price. So, and I had a cover of 1.5 or 1.6, something like that. So with a cover of 1.5, if I'm comfortable at say 400 rupees, I would be comfortable at 250 rupees. That's what I'm saying. So it's a comfort on the zero debt company against which we have done, we have given advance.
Okay, so I think it's important for investors to kind of assess these things as well. And if you can't assess, maybe take in a help of a reasonably good mutual fund advisor to help you put in money in mutual funds in that fashion. But this was informative, Mr. Shah. Thank you so much for taking the time out and spending time and talking about all of this. We wish you and the industry all the best as well.
Thank you.
And hopefully investors make even more during the course of the next few years as compared to maybe 2018 was a bit of an aberration. But thank you so much for joining us today and giving us your thoughts. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.